Hey everybody, Boris, BK Forex. Welcome to the weekly technicals for the majors for Eurodollar, dollar yen, and pound dollar for April 1 to April 4, 2019. The theme this week, of course, is all eyes on US data because it's really going to be the week where the market is going to essentially debate whether US is in a truly serious slowdown or perhaps starting to now even out and create a soft landing and perhaps a takeoff into the second half. And it will determine whether U.S. yields are going to go up, whether the dollar is going to strengthen, and all things in the FX market that are going to be very important. Remember that the latest communication from the Fed, last month's communication from the Fed, I think spooked the market because the Fed was so unadulteratedly dovish that the market feared they may be seeing something in the data that they are just simply not aware of. So we have this week lots of very important US data that's going to either confirm or deny the bear's thesis that in fact we are not recovering from the slowdown in Q4 and that there is a secular slowdown now in the US that is going to essentially be similar to one that's in Europe and one that's in Asia. So the levels as far as the majors go starting to really compress here. Eurodollar is just getting tremendous amount of pressure, both from the fact that you have negative yields in Germany, that the slowdown in Europe doesn't seem to have any possibility of a recovery, and this new fear that the trade war, which is already hurting Europe because obviously slowing down demand from China, is actually going to now flow over onto the shores of Europe if Trump administration decides to put tariffs on European cars. Add to that the fact that generally the interesting thing here is that because cars are such a key component of European export demand, the slowdown for consumption of automobiles is just having a massive, I think, flow-through effect in all of European economy, and that's it seems to be really depressing euro at this point. Dollar yen, on the other hand, tested and held the 110 level, despite the fact that we have yields continuously going down. And I think a lot of it is just really part of it is on risk on flows, which has helped the dollar yen this week, but also I think on the assumption that maybe the U.S. economy rebounds, and that I think will be an incredibly important test this week. If that doesn't prove itself to be true, that 110 level is going to go by the wayside in many ways. Cable, its own crazy Brexit story. Still, the market continues to buy the dips at the 130, but here's the thing. The closer we get to the deadline, we've passed, of course, the first deadline, but the closer we get to the April 12th deadline, without any semblance or appearance of a reasonable deal, the stronger the possibility that it could actually be a hard Brexit spin-out. Now, that still seems a very remote possibility. Markets are only pricing about a 10% chance of it, but it seems to be such a mess at this point that the bears do have this potential, and if there is this kind of a last-minute disaster, unintended disaster, it could be like the Brexit disaster, which is the cable could lose 10 handles, 10 figures in a day on just a hard fallout because nobody was really watching the store. So it's a very hard trade to trade. You have to give yourself a tremendous amount of room here and trade very small, and it's impossible to handicap it from the charts. But still, the conventional view, the dominant view in the market, still at the 130 remains to be a buy. Now, the calendar this week on the major is actually quite important. We move away from just a pure political domination of trade to, more importantly, economic domination. And here, the two really primary data points, one at the front of the week, one at the back of the week, are really going to tell us everything we need to know as to the state of the U.S. economy. Retail sales on the U.S. side, we're actually bullish this number, but it's a question of just how bullish this number will be because we're mildly bullish, medium confidence on the idea, based on the fact that gas prices rose sharply and we had relatively decent wage growth in February. But consumption itself has been muted, and that's really the key thing. Maybe U.S. consumer is simply saving rather than spending, which is going to be very negative U.S. economy. So retail sales a really important read, especially if it doesn't really blow up. Like if it's a 1% gain, now it certainly would be tremendous. But the market consensus now is really for the control group to only be 20 basis points, which is very mild spend into February, and really certainly not anything that really spurs up and juices up the GDP growth as we go forward. ISM manufacturing, also another important read. We are also mildly bullish that because the strong Philly offset Empire and Chicago, but I am probably in disagreement with Kathy on this because I think Chicago is the much more important PMI and the fact that Chicago was down suggests maybe manufacturing is slowing down as well. On the UK side, we also have PMI manufacturing. That will be, as usual, a non-event. It may have a negative impact only because in light of the fact that you have this tremendous amount of doubt about the Brexit resolution, any kind of a weak production number out of UK will only add to the woes. We'll certainly test the 130s if it's a negative number on Monday morning on the open, but it's going to be a temporary flight because the focus will turn right back to the Parliament right away. Now into Tuesday, we have durable goods, durable orders. That's sort of a minor event. Wednesday, we have the final readings from the PMI data. These were really horrid numbers that pulled the euro down so badly in the middle of the month. We'll see if there's any kind of improvement as the final readings come in on Wednesday. Then retail sales out of Europe, again, a very minor read. Wednesday, we'll also get the ADP, which will be the first inkling of where the payroll data is. ADP has just been a very decent predictor. It's actually, the longer it's been, I've noticed that in the last year or so, ADP has actually been a very, very close mark to where the true numbers have been. Now, I don't mean by that they actually mirror what the actual numbers are, but what they do mirror really well is the revised data, meaning that they're a pretty accurate read of the actual labor demand in the economy. So the key thing here is if ADP is projected about 160, 150, that's a pretty decent read. It'll be fine. If the ADP shows anywhere below 150, that's going to be a serious yellow warning sign to the market about the possibility of a slowdown in labor demand. Some of the people who've been looking at the forward-looking data noticed that the one thing that is trending negative is the small uptick in weekly jobless claims. And again, there is not a direct correlation there, but it could be a warning sign that the labor market in the U.S. is kind of peaking. We'll have to see. ISM non-manufacturing also has the employment component inside of it on Thursday. That's a very, very important read. So we'll have actually two very good data points ahead of the non-farm payrolls on Friday to give us a pretty decent idea of just how the labor numbers should come in. So we'll see. Labor numbers are expected to, last month they were horrid, but the wages were pretty good. This month, they're expected to essentially be back to this 150, 175 range, which is where the normal equilibrium rate of labor at this point is, with the market looking, again, for a average hourly earnings of around 20 basis points instead of 40 basis points last week. That's actually not going to be that great. We need to see 40 basis points. We really need to see inflationary pressures, wage pressures in the economy for the market to feel like there's going to be enough momentum for forward spending. If wages continue to remain very muted against this torrid labor environment, that's just not a good construct for higher rates and stronger dollar. So that's how the data shapes up into the week. As I said, it's a very heavy-duty week for the majors this week. Let's take a look at the charts and see what's going on over here. And the charts, of course, are not coming up to a third test of this pivotal 112 level. This is really where we call the rubber hits the road, as 112 is going to gets tested. The only positive thing I can say about the euro from this chart is that the deceleration momentum, that is the rate of descent, actually is slowed down. I mean, that is a backward complement if there ever was one, meaning it's not declining as fast as it should be, meaning that maybe the sellers are getting more and more exhausted, and there's clearly seems to be some underlying bid here. But this bid is very phantom. I think if they break the bid at the 11.75 here, especially, and this is the key thing, you get this sort of a 1-2 combo of a continually weak European data and really like a powerful upside U.S. data. If the U.S. data signals a revival in the fortunes of the U.S. economy into the first quarter of the year, especially the labor markets and wages, that will revamp the whole narrative of the Fed possibly reviewing the idea of a freeze on rates. U.S. rates, which have just been massively depressed below the 250 level, could pop back up above 250. All of this will drive the euro through 112, and most importantly, will then really create the perfect conditions for a move towards 110 in a relatively quick fashion. It'll be a big repricing, I think, as the market will completely change its mind into this binary view of the world of pro-dollar, anti-Europe. So it could be a big move for the dollar bulls and for the euro bears if we get the proper catalyst. On the other hand, if we don't, it's going to be just another quagmire, and it could be a triple bottom test here. So I think it's very important, very, very key thing to watch here as the week develops. In many ways, a very pivotal week here. Cable, I don't even know what to say about cable. Cable looks obviously mildly bearish. We're holding the bull battle here at the 130 here. The support at 128, that's the next sort of key support here. If the market feels like there's just complete pandemonium and chaos in the UK Parliament, we could come down here. And then if there becomes an incredibly fevered worry that the Europeans will simply just say, no, we're not going to give you the extension, just go away without a deal, you could have a quick deceleration to 125. And I would say even the post-Brexit lows, I mean, I think it's worthwhile to maybe examine the weekly charts here just to understand the potential of what a hard move that would be. So this is the post-Brexit lows were around 119. There is little doubt in my mind that a hard Brexit would take us there. And everybody will then be talking about parity pound, something that has not been that's not even been an imaginary thought for more than 5 decades. So all of this could be very dramatic in the next month or so, really worth watching, but also incredibly difficult to trade because of the volatility of the trade. Anyways, the last of the majors for us, take a look at yen. And this is sort of the pro-dollar story. There's a very mild but very discerning pro-dollar bid in the charts here, with the market setting up essentially for this thesis that U.S. growth rebounds. And that's really what this whole week is about. If we get confirmation that U.S. growth rebounds, and assuming we don't have any ancillary, non-predictable, random variables that hurt the market, we're setting ourselves up for a break at a 120 on the euro and a takeout and a move towards the 112 in a dollar yen as the week progresses. That's the majors in a nutshell. I wish you guys the best luck, the best of trading. Boris, over and out.